Hello everybody and welcome to my monthly Vietnam update. September was definitely the worst month for stock markets since we were hit by the pandemic back in March 2020. Increased geopolitical tensions and interest rate hikes across the globe pushed equity markets in the US and Europe lower. Also, the Vietnamese stock market declined sharply in September and the VN index lost 13.1% in US dollar terms. And also the NAV of our AFC Vietnam Fund closed the month 9.9% lower according to internal estimates. Hi, my name is Andreas Vogelsanger. I'm the CEO. Don't forget to subscribe to our YouTube channel and switch on the bell so you don't miss any uploads. One of the main topics for global investors in September was the renewed worry about recession in the US and Europe after central banks aggressively hiked interest rates. This triggered a sharp sell-off in many stock markets around the globe this month. With higher than expected interest rate increases, the market seemed to go through a crisis of confidence, wondering how far the Fed and ECB will need to hike interest rates in order to bring inflation back under control. Also, Vietnam Central Bank decided to increase its policy rate by 100 basis points a little bit more than a week ago in an attempt to keep inflation under 4% this year. This rare monetary tightening of the State Bank of Vietnam followed shortly after rate hikes by the US Federal Reserve, the ECB, European Central Bank, the Bank of England and other central banks around the region as inflation rose across the world. I should definitely talk about the strong US dollar. The reason for the US dollar strength is that in times of elevated geopolitical risk and macroeconomic uncertainties around the world, the US dollar benefits from its perceived safe haven status. Also, the Fed has been much more aggressive in hiking interest rates than its peers. But the situation in Vietnam doesn't look as bad given its strong macroeconomic numbers. The 4% or the 4.4% weakening of the Vietnamese dong versus the US dollar since the beginning of the year compares relatively favorably to most other Asian countries. So, what about inflation? In order to carefully control inflation, the Vietnamese government, through its petrol and oil price stabilization fund, intervened in the market to bring the petrol prices from its recent peak of 32,873 Vietnamese dong per liter down to 22,580 Vietnamese dong per liter. That's around a 31% price decline from its peak. The government reduced, for example, taxes and fees on petrol prices and improved policies to increase production of local oil refineries. The latest CPI numbers from end of September showed an inflation number of 2.73% year on year, which seems to be very, very manageable. Even though inflation is not a concern at the moment in Vietnam, the latest 100 basis points rate hike by the State Bank of Vietnam showed that it's determined to keep inflation below its 4% target this year. This latest monetary tightening increased the discount rate from 2.5% to 3.5% and the refinancing rate from 4% to 5% per year. Also, interest rates of Vietnamese dong-denominated deposits will increase by 0.3% to 1% depending on maturities. The Vietnamese stock market dropped by a moderate 0.94% after the interest rate hike announcement. But as expected, insurance stocks jumped on this very same day. As mentioned in our previous reports, higher deposit interest rates have a positive impact on insurance companies' profitability, since they hold large bank deposits which generate higher interest rate income, which is contributing more than 80% of insurance companies' net profit. This is also the reason why our fund was able to perform slightly better than the VN index in September, given that around 20% of our portfolio is invested in insurance stocks. In September, Moody's Investor Service upgraded Vietnam's long-term credit rating to Ba2 from Ba3. Vietnam is the only country in Asia Pacific and one of 4 countries globally to have ratings upgraded by Moody's since the beginning of the year. This shows Vietnam's economic strengths and greater resilience to external macroeconomic shocks that are indicative of improved policy effectiveness. Moody's expects the situation should continue as the economy benefits from supply chain reconfiguration, export diversification, and continued inbound investment in manufacturing. Over the past 10 years, Vietnam kept improving its economic fundamentals, such as, for example, current account, trade balance, foreign reserve, and hence Moody's has upgraded Vietnam's credit rating since 2012 from B2 to now Ba2 in September 2022. So, this was all from me. I'm looking forward to talking to you again end of next month when we come up with our October update, which hopefully looks a little bit brighter. Goodbye.